Many people think that gold should be part of any investment portfolio, and the justification they give is usually twofold. The first is that when equity markets crash, gold tends to rally and it reduces your overall loss. The second justification is to do with inflation. When the price of goods and services goes up, then gold tends to hold its value. But is this borne out by historical data, and what are the historical drivers of gold's price? Let's look at that in a bit more detail. This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. This is the price of gold since the 1930s in dollars per troy ounce. If you look at the first half of the graph, you can see that it's kind of blocky and constant for long periods of time. That's because of the gold standard. Until 1933, these gold certificates could be used as currency in the US. If you had one of these certificates, you could cash it in for physical gold, and the price of the US dollar was also linked to the price of gold. This ended in 1971 when President Nixon announced that he was suspending the convertibility of the dollar into gold, and suddenly the price of gold could vary according to market forces, and the result was an extremely strong rally in gold, or conversely a weakening of the dollar. One of the benefits of holding any asset is the income that it generates. So for example, if you hold these Marks and Spencer shares, you're paid a dividend. So if you buy £100 of the stock, you'll be paid £6 a year dividend. Corporate bonds also generate an income. So if you buy this Imperial Tobacco bond, for every £100 face value of the bond that you own, you'll be paid 5.5% per year in interest payments, which are called coupons. But one of the big problems with holding gold is that it doesn't generate an income. In fact, it'll cost you to hold it. In finance, we call this a negative carry cost. The reason why having an income is useful is that it allows us to calculate the fair value of any asset. So let's say we buy a share. On day one, we pay out cash, so that's a negative arrow downwards. After some period of time, we're paid a dividend, which is a share of the company profits. Notice that's an upward arrow because it's a source of income. As time passes, we get another dividend. And what we find is that earnings tend to trend upwards in value over time. And it's this upward trend in earnings which drives up equity prices over decades. And we'll continue getting those dividends for as long as we hold the stock. And although we don't know exactly what those dividends will be, we can make a fairly good guess, and by adding up the value of those future cash flows, discounted using something called the risk-free rate, we can come up with an assessment of the fair value of a share, which is great because then we know when it's expensive and when it's cheap. Now let's compare that with gold. We pay to buy gold on day one, but instead of a dividend, we have a storage cost, and that carries on forever. Now that means that we can't work out the fair value of gold, so we'll never know if it's expensive or if it's cheap. The price of gold is simply what people are willing to pay for the shiny metal. Now let's see how gold has performed historically. Here's a comparison with the S&P 500. Since January 1st, 1972, the average annual return of gold has been 7.3%. And that's exactly what you'd have got if you bought the S&P 500. But of course, one of the benefits of the S&P 500 is that it generates dividends. And if we reinvest those dividends over time, the total return of the S&P 500 gets boosted up to 10.5% per year, which means that it's massively outperformed gold over this period. So you can see the power of having an income from any asset. Gold is usually quoted in dollars, like any commodity, but how does it look for sterling investors? To get the value of gold in sterling, first we'd sell our gold for dollars, and then we'd sell our dollars for pounds. Like any asset which is denominated in dollars, when the pound gets stronger versus the dollar, the value of gold goes down. And when sterling weakens versus the dollar, the value of gold goes up. That's assuming that the price in dollars is constant. But if we look at the value of sterling versus the dollar over a very long period of time, in the middle of the 1970s it was trading at about $2.50 for every pound. And it's gradually weakened such that nowadays it's worth about $1.30 per pound. And that weakening of sterling over time has boosted the value of gold in sterling compared to the value in dollars. But even if we take that boost into account, the FTSE 100 has far outperformed gold since 1984, and that's not even taking dividends into account. Now let's look at what historically has driven the price of gold. One of the things about gold is that it's very dense. So when the Earth formed, a lot of the gold sank to the Earth's core. And that means there's not much left in the crust, which is where we live. In other words, gold is scarce, and that pushes up its price. In fact, if all the gold ever mined was to be melted down into one big cube, it would be about 21 meters on each side. That's enough to fill 35 double-decker buses, or enough to fill about 1/10 of the Albert Hall. The thing to remember is that gold is a currency. If you look on Bloomberg, you'll see it quoted using the symbol XAU, because the Latin name for gold is aurum. So when the price of gold goes up, you could see that as a weakening of the dollar rather than just the strengthening of the price of gold. So how can we tell the two apart? The way we do this is to compare the price of gold to the strength of the trade-weighted dollar, which is a weighted average of the strength of the dollar versus a basket of its trading partners. These are called violin plots. On the left in red, you can see the annual return of gold when the trade-weighted dollar is weakening. And what you'll see is that most of the time it's above zero. So as the dollar weakens, the price of gold goes up. And in blue on the right, you can see what happens as the trade-weighted dollar strengthens. And as you'd expect, as the dollar strengthens, the value of gold goes down. So when the dollar's strong, the price of gold falls. Now, because gold generates no income, when interest rates go up, you can buy US Treasuries, which bear almost no risk at all, and they generate an income which is increasing. In fact, we have to look at something called a real yield. That means we take away the rate of inflation from the yield. And you can see that when yields are high, gold becomes less attractive because it generates no income. So the returns tend to be lower when real yields are high, and higher when real yields are low. But what if we look at inflation on its own? There really is no convincing relationship between the rate of inflation in the US and the annual return on gold. In fact, when inflation was very high on the right in blue, you can see that the return on gold was often negative. So as an inflation hedge, it does a very bad job. Now let's get an idea of the outlook for gold based on what's happening in terms of macroeconomic trends. The Federal Reserve has had zero interest rates for many years now, but we find ourselves in a new environment in which rates are steadily increasing. And as we saw, when interest rates are increasing, the value of gold tends to suffer. And when interest rates rise in the US, the trade-weighted dollar also tends to strengthen. And that's precisely what we've seen. Now, neither of these, rising interest rates or a stronger dollar, bode well for the price of gold. How about the value of gold as a diversifier? I've plotted here the rolling correlation, which is a 30-day window of correlation, which I slide over time from the 1970s to the current day. When it's blue, that means that the S&P 500 is positively correlated with gold. When it's red, US shares are negatively correlated with gold. And I think it's quite clear that gold is not a reliable hedge. In other words, it doesn't always have a negative correlation with equities. Sometimes buying gold doubles up the risk of your portfolio because sometimes it's positively correlated. If we compare that with US Treasuries, although it's not a perfect hedge, most of the time Treasuries have a negative correlation with US equity. That's what happens with everyday returns, but what about during crashes? The x-axis shows the S&P 500 return, and the y-axis is the return of gold. If we want gold to be a good hedge, we care about this left-hand panel, which is what happens to the price of gold when the S&P 500 falls. And you can see that usually it rises in value, although the big rises in value were in the early 1970s, just after gold came off the gold standard. Unfortunately, there are also times when the value of gold dropped alongside that of equities. And more worrying still is that gold itself is very volatile and crashes. So in 1981, it fell by almost 30%. Now, if you want an equity hedge, you don't want one that introduces more crash risk into your portfolio. You want it to reduce the risk of your portfolio. And if we compare that with treasuries, you can see that the largest loss there was minus 8% in 2013. So gold isn't a particularly convincing equity crash hedge. So to summarize, gold is a poor inflation hedge, A poor equity hedge generates no income. In fact, you have to pay to hold it securely. And the fact that it generates no income means that we can't compare its price to its fundamental value, which means that its price is a matter of speculation. So you can probably tell I'm not a massive fan of gold as part of my portfolio or other commodities for pretty much the same reasons. Now, if you found that video useful, and many of you tell us that you do find our videos useful, then consider supporting us on Patreon. It's really easy. You just go to the Patreon website and click on our page, and you can support us for as little as $5 a month, and that'll make the difference for us of being self-funding or not. So let me just quickly read out the names of our current supporters: Barry Pooley, Taher Esfandiari, Gabriel Matisse, Andrew Trott, Alan Popescu, Mark Haywood, Lee, Steve Lambert, Elizaveta Sheforostova, Adam Gilmore, Hugh Valentine, Alex Kemp, Gintautas Gerulaitis, Louis Mayer, Corn Dutois and Robert Guerrara. So you can find us on Patreon or subscribe to our channel by clicking the links above, and thank you for listening.